makers and market movers. This is The Pulse with Francine Lacqua.
Thursday the 4th, good morning. Welcome to The Pulse. I'm Guy Johnson. I'm not Francine Lacqua. We've got some great conversations that matter on this show. What do you need to know? What's coming up on the programme? European stocks, well, they're steady ahead of US jobs data. Claims is out later. Got payrolls tomorrow. Jerome Powell reaffirming the US Fed will likely lower rates this year. The NATO Secretary General is giving remarks later this hour as the military alliance celebrates its 75th anniversary, highlighting the tough spending decisions that Europe must now face as it looks to rearm. And this week on Bloomberg UK, our deep dive with one of the country's most prominent female chief executives, Amanda Blanc from Aviva. Looking forward to that conversation. Let's talk about what is happening with these markets right now. To be honest, we're waiting for claims. We're waiting for the payrolls. European markets broadly bid this morning. Mining stocks are doing better. That's where you're seeing the push higher. You are seeing commodities coming up. You've also had some slightly more positive data coming out of China. So that's what we're seeing across Europe at the moment. Italy flat, but you've got the CAC up by 0.2%. The FTSE's up by 0.2% as well. Let's look forward. What's happening with US futures right now? This is the picture that you are looking at there. We're mildly positive. I think we're still digesting the move yesterday that we saw from Powell, but actually I thought the bigger story yesterday was the ISM services story. The print there, weaker than anticipated, particularly when it comes to prices paid. That's a disinflationary story. Nasdaq futures up, stock 600 up by 0.1%. As I say, that is being led this morning by the mining story. Let's talk about commodities. Let's show you what is happening there and move across to some of the other assets that we're watching. A little bit of softness creeping into crude, but we are up near 90. Look at this, Brent crude up near $90 a barrel. Gold continuing to do very well over the more medium term, but today a little bit of softness creeping in. Why are people buying gold right now? Maybe that's something that we should be exploring as well. Copper's up, euro dollar tracking a little bit higher. So over the last 10 minutes you've had French PMI data that looks better than anticipated, particularly on the services side, and German data, interestingly enough, actually looking a little bit more positive too. So the European data may be beginning to turn just at the margin, which is interesting because it was the service data yesterday on the ISM front out of the States that saw a little bit of a slowdown. Maybe we're seeing a turn here in Europe. But the big feature of yesterday's landscape was what we saw from Jerome Powell. The Fed chair, Jerome Powell, has been signaling once again that he thinks that his central bank will wait for clearer signals of lower inflation before it starts cutting rates.
Recent readings on both job gains and inflation have come in higher than expected. The economy added in an average of 265,000 jobs per month in the 3 years through February, a faster pace than we have seen since last June. These recent data do not, however, materially change the overall picture, which continues to be one of solid growth, a strong but rebalancing labor market, and inflation moving down toward 2% on a sometimes bumpy path. If the economy evolves broadly as we expect, most FOMC participants see it as likely to be appropriate to begin lowering the policy rate at some point this year. Of course, that outlook is still quite uncertain, and we face risks on both sides. Reducing rates too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%.
Let's figure out exactly what he said yesterday and whether there was anything really new in what he said. Erik Nielsen, Group Chief Economist at Unicredit, joins me on set. Morning.
Good morning.
Do you make anything of that? Was there anything new in there?
No. I think it was a repeat of what we heard from the FOMC and another speech. Very sort of steady story, comfortable. But, yeah, sometimes it's a little bit difficult depending on how the questions come. And sometimes if you really want to read something different into it, you may be able to. I think it's the same story.
Should we be comfortable with the idea that the Fed's going to cut 3 times this year?
Yeah, I think so. It really depends on... he talked about the bumpy road on inflation, but also I think it depends a lot on what the economy does, right? If you're pacing away, as far as I can see, you're probably looking in the first quarter at something close to trend growth, down from this incredible growth rates in the last part of last year. If we are zooming along at trend, maybe we don't get quite 3, maybe we get 2 only or 1 only.
This year.
Yeah, so I certainly think that if you have a little bit of more bumpy road and the economy stays strong, as it seems has been in the first quarter, then I think the risks to those 3 are clearly on the downside.
OK, so let's say we get 2 this year. Does that mean we get 4 next year? Should I think about the total being 6?
Yeah.
and it's just kind of 2 this year, 4 next year, 1 this year, 5 next year.
Yeah,
How do I think about how the mix works?
Yeah, I think, no, exactly. I think you want to think about where they're heading, right? And they're heading down because by all probability, you're heading to some sort of a landing of a type. Otherwise, an incredible miracle has happened in America. And maybe it has. But the base case must be one where you slow. At one stage, you have to rein in the fiscal and all the rest of it.
You think that, but maybe we'll wait and see. We'll talk about politics in just a moment. We're going to talk about fiscal a little bit later. OK, so in theory, you're talking about a landing. But here's my question on that. Is the Fed going to deliver mid-cycle? Is this a mid-cycle slowdown that we're seeing? This is the bit that I still can't figure out. And are these cuts mid-cycle slowdown cuts? We were talking to PIMCO a little bit earlier about this, Andrew Balls. Yeah. And his view may be that this is what we are seeing, that this is actually just a mid-cycle slowdown and we get mid-cycle cuts. You get 2, maybe you get 3, but maybe you don't get 6.
That would be incredible, right? It's possible. I mean, the way I see it, first of all, I don't like to think about it as a cycle because we have had these enormous shocks, right? Yeah. So it's not your normal business cycle rolling up and down. We had a multiple shock starting from the COVID, the fiscal expansion in America, which we'll come back to, right? And then we had the commodity price shock, which was a terms of trade gain in America, a loss in Europe, right? So we have all these things plowing through the system. So is it a normal cycle? It's certainly not a normal one. Is it a cycle where we can debate that? But the point here is that it seems to me that you're pounding along on all cylinders. The stimulus,
in America,
only in America. Yeah. The stimulus is likely to be reduced. I know we're going to talk fiscal later on, but on Brookings' estimate, the fiscal has already had a small drag in the first quarter of the year, after having been massively stimulus before. And the monetary policy, even if they start to cut sometime later this year, the lagged effect of the hikes are still to come in and hit us. So I would argue that the U.S. probably sometime in a year's time or something is going to see a couple of quarters of close to zero growth. That's not a drama for a couple of quarters, right? But it is in that scenario. And inflation coming back towards 2%, they're going to cut rates. Is it 6 times or 5 times? I don't know. But it is a lot, right? But the big thing compared to Europe is the economy is pounding ahead, and they are a little bit more reluctant and will be more reluctant going forward.
Could you see... Now let's play the game of kind of compare and contrast. Could you see 4 rate cuts this year from the ECB and 2 from the Fed? Kind of walk me through the implications of potentially what that would look like.
Let's start by this. So my opinion is that that's probably what we should have, right? And the reason is that Europe is still flat on its back. You reported just before the hour correctly that it looks like, or just now, sorry, that the numbers in Europe look a little bit better. But we are still...
But only a little bit.
A little bit. And these PMIs are still around 50, right?
Yep.
We are still flat on our back, maybe marginally, right? And inflation has not had a bumpy road here. We are coming down very nicely. Over the last 6 months, annualized, the European inflation number is below 2, right? 6 months, annualized, right? So it's coming down very rapidly. ECB has way too tight monetary policy. Will they do 4 this year? No, because they just can't get their head around this. They will start in June, and then we will see what happens.
Does the Eurozone need a cheaper euro right now?
I don't think that the exchange rate is massively important for Europe, but I mean...
Every little helps, right?
A little bit helps, yeah, exactly. And I don't think the inflationary impact of a cheaper Europe would be a problem. So for the inflation story, because I think we are heading to 2 and probably below 2. So I think it's, if you say what they need, if I were sort of the economic master of Europe and I could... dictate the exchange rate, then I would take Europe down around parity. That would be good for Europe.
That would be good for Europe.
Yeah, I think so, definitely.
Is there a negative? If we're in that kind of scenario, how do I think about longer term rates? And I think the bond market is trying to figure this one out as well, and trying to understand: does Europe end up with a much lower kind of duration story, longer-term rate story than the US has? Is the US just potential so much greater that we're going to end up with a big differential in terms of where the rates narrative ultimately ends up in the kind of scenario that you're painting?
Yes. It's always been about a percentage point different in sort of the arc star, whatever whatever it is, type of thing. But that's sort of historically. And I don't think there's any reason to think that will be materially different going forward, with the caveat that it could be a bit wider. And the reason is demographics, where Europe looks particularly bad, but also productivity. Productivity numbers have been horrible. I don't think they're quite as horrible as the headline number tells you. We can talk about it separately. But European productivity is dismal, right? It's negative in the first quarter, right? So that sort of 1 percentage points difference could very well be a bit bigger in the future.
We are going to talk about the fiscal next. I think today's a really interesting day to talk about the fiscal, because I think NATO's celebrating its 75th anniversary, and I think there's a really interesting kind of take on that we need to think about how Europe is going to ultimately deliver that fiscal story. So Erik Nielsen is going to be staying with us. We're going to talk much more about what is happening with that NATO story. It's marking its 75th anniversary. More defence spending appears to be on the cards, but is that a trade-off that we need to think about? Are we going to be spending on weapons but not on welfare? And what does that mean for the European model going forward? We'll talk about that next. This is Bloomberg. Fourteen minutes past the hour. Welcome back. This is The Pulse. I'm Guy Johnson in London. Francine Lacqua off today. Let's talk about what is happening in Brussels right now. NATO foreign ministers are meeting there. This is the alliance marks its 75th anniversary. An opportunity maybe to look back, but certainly an opportunity to look forward. Can Europe afford to do what it needs going forward to support NATO? Defence spending is critical right now, but how does it ultimately get paid for? And are we going to have to, potentially here in Europe, if we are going to fund defence spending, sacrifice in other areas? For instance, what is happening with welfare? What is happening with the energy transition? These are key questions that Europe has got to figure out. Let's pose that question now to Erik Nielsen from Unicredit, who is still with us. I think this is a great opportunity to talk about the priorities of Europe. Right. Europe, we're celebrating 75 years of NATO, an organisation that has provided the security architecture for Europe. A third of European members, of NATO members in Europe, still don't match the 2% defence spending. They're going to have to, certainly if Donald Trump comes through. That is going to be a floor, not a ceiling. Are we going to have to make some really big decisions here in Europe about where we spend money and how we spend money? Is it weapons over welfare?
We have to make big decisions. Let's start by the bad news. I think 2% is probably the low end. That was a number that was established in peacetime, and now we have war on our borders. So you could easily argue for 2.5% or 3%, thereabout. So you're looking for defense. To get there, we spent about 1.5% on average in Europe last year, a little bit less. Yep. So let's say that you need 1 to 1.5% of GDP in extra spending per year. Right? Yep. That's a lot of money. But it's not impossible, right? It's definitely feasible. I would argue that there are two ways of doing it. You can either, as you implied, you can find other things to cut. That's politically difficult. Let's be very clear. I'm not a politician, but I can watch how hard it is to cut spending. Or you can raise taxes, also very difficult. Or you can borrow the money. My argument, and what I think is happening in Brussels, is that they're looking increasingly towards borrowing it collectively, because it's a collective obligation in a sense. Of course, that debt has to be serviced one day in the future. But it comes on the side track with this beautiful thing that if we had more European debt, we also had suddenly a risk-free European asset or euro asset, which would get a lot of other good things coming on. So I have long been an advocate for borrowing collectively what is collective issues.
So that would include. So we started off with the pandemic. We did it then. That was the kind of we broke the ground on that.
Exactly.
If there were, and at the time I was told, I talked to a lot of politicians about this. It was a one-off.
Yeah.
But if it's not a one-off, it starts to become more normalised. You start to create that asset class. Do I include? Would green spending be included within that? Would that be something that we should do more of as well? There. What other things could be included?
Yeah, I think those are the two obvious ones: defence and green spending. Right. Yeah. It's impossible to argue that any one country can do defence or green spending alone, and it's like pollution that goes all over the borders, and the defense is the same, right? So I think those are the two obvious ones. But we're not there yet politically for whatever reason. So it will take time.
Can we get there? Because this is, you and I have talked a lot about this in the past. Europe struggles with speed.
Yeah.
But it feels like speed is of the essence right now.
Yeah. So, I mean, you mentioned it before. I mean, the obvious trigger is Donald Trump winning in November. And then saying some of the many crazy things he says about Europe and NATO and all the rest of it. That probably could energize Europeans to say we have to do it ourselves. But then by the time you agree to spend the money, issue the money, spend it, build the capacities, and it's not only a matter of building tanks and weapons and stuff, it's technology, right? And we don't have it in Europe. So it's a massive task ahead, and as you said, speed is of the essence. And the problem is we sometimes in Europe we are so scared of making a mistake in this. So we build by consensus, and we wait and wait and wait, and instead of plowing ahead and then correct mistakes as they inevitably will happen. But that's what.
Do you think it's countries like Italy that I think it'll be interesting in this process? This presumably would be good for Italy. This would be good for countries like Italy, which look like they're coming off potentially quite a lot of fiscal spending right now, and they're going to have to potentially pay that bill maybe sooner rather than later. Do you think that everybody is going to be on board with this? Do you think Germany would be on board with this? I can see countries that would be on board with this, but is everybody going to be on board with this, Germany in particular?
I think you're right, pointing or asking the question about Germany particularly. They certainly have the industrial capacity. They have a good deal of the technological capacity, but they have a political kind of a hangover that they worry about being seen as leaders in military matters for reasons we all understand, and I think appreciates, generally speaking, right? So it's as a German politician once said to me, it's difficult to be a German politician because they want you to lead. When you then in one space start to lead, and then we don't want you to lead in that direction, we want to lead in that direction. So what do you want, right? So it's very difficult. Unfortunately, we may have to have a bad event, a Trump election or an expansion of the war for Europe to really get its act together.
We'll watch. Eric, nice to see you this morning.
Good to be here. Thanks
for the analysis on this. Erik Nielsen, Group Chief Economist, Economics Advisor over at Unicredit. OK, where are we going to take you next? Google reportedly weighing fees for AI-powered search. We're going to take a look at what this could mean for its business model going forward. That's next. This is Bloomberg. Welcome back. You're watching The Pulse. I'm Guy Johnson. Let's talk about the tech news that we've been getting out over the last 24 hours. A couple of stories that I think are really fascinating. Alphabet reportedly considering charging for web search features that are powered by AI. Alex Webb joins us now to discuss this. We're spending a lot of money. These companies are spending a lot of money right now on buying chips from NVIDIA, making their AI work. It's expensive. Is this an example of them struggling potentially to monetize it, to make money from this? And how big a challenge could that be?
Well, I think a lot of the spending they've been doing from NVIDIA in particular on data centers is actually to do with their cloud business. They want to sell a lot of these features to companies that want to use AI features themselves. But at the same time, Google itself, its core business, they're trying to pivot the whole business towards AI. As you say, it is hard to do it for free because each search at the moment, or each AI query, can cost a few cents to process, right? Depending on what it is, depending how big it is. And so you can't afford to do that at scale for whatever 3 billion people doing searches every single day. At the same time, if you are charging, that kind of caps your upside. There's a reason that Meta, Facebook, doesn't charge to use its services. It's because in the US, in some years or some quarters, it makes like the equivalent of $20 a month per user. So if you're capping the ad-free version at $10 per month per user, and it's not something investors will necessarily jump at. So there's an interesting thing to be balanced here of how you kind of... Now, sorry, one caveat is that over time, that cost will come down. So maybe it's that you charge to begin with, and then gradually as the costs come down in the years ahead, then you can remove that paid tier. But for now, it seems like it's the only way to cover your costs.
Great story out of Bloomberg overnight, talking about the fact that Apple is looking at robotics as being, rather than cars, it's going to be looking at robotics. Just tells me that Apple's a hardware company, not an AI company. Is that the correct read of this?
Yeah, I think so to an extent. Like Apple, firstly, huge caveat again, Apple does lots of research projects that never come to anything, right? Yeah. And sometimes gets quite a long way down the garden path before giving up on it. But AI is a software thing. This is trying to find a way of putting automation into hardware. It's going to be very expensive for the end consumer. It's hard to see the use case.
Alex, great stuff. Thank you very much indeed. Bloomberg's Alex Webb. What have we got next for you? Our interview with the Aviva CEO, Francine Lacroix, sitting down with Amanda Blanc. We're going to talk about consolidation, diversity. All of that is coming up next. This is Bloomberg.